So you can kind of see the slides a little bit in the movie recording here. We'll just see how we do with that. I would encourage you, obviously, as you listen to this, to maybe look at the, maybe turn the audio on this and actually look at our slides together. But we're going to go ahead and start here with slide 45, just to review our levels of control. And go through this again. So our levels of control are going to control our accounting for an investment in equity of another company. 20% presumes lack of significant influence. We're going to use the fair value or cost method. We're going to fundamentally account for that stock investment, no different than if we bought 3,000 shares of Nike. As we receive dividends, it's going to be a debit to cash. It's going to be a credit to income. We're going to recognize dividend income. We'll adjust our fair value as an item of comprehensive income. Will be our fair value adjustment, but basically we're going to continue to carry it at cost in our financial statements. If it's not publicly traded, we will truly carry it at cost. 20 to 50% presumes significant influence. We're going to use the equity method, which is a fundamentally different way of accounting for that investment. We're actually going to recognize our share of the earnings of the investee based on our ownership percentage and based on their income as adjusted for some of our fair value adjustments. And we're going to actually reduce the investment for the cash we receive for the dividends. So the dividend accounting is very different when we're using the equity method of accounting. Then our 50%, which presumes control, that's going to go to our consolidated financial statements. And there, it's going to very closely parallel the same type of accounting techniques we used for the equity method. And so you'll see as we get into chapter 4, 5, and beyond, we're always presuming that our parent corporation, in their separate financial statements, they acquire a subsidiary. You know, it's kind of like you meet once a year. It's the wedding that occurs once a year. You meet once a year. That you've got the parent corporation that acquires the subsidiary. They go their separate ways during the year with their accounting. They each keep their separate statements. But the parent is tracking the subsidiary in its own books using the equity method. Then they come back together at the end of the year. They consolidate. We eliminate that investment and go to full consolidated financial statements, you know, for the entity. So this very closely parallels this treatment here, and they are connected. This is fundamentally different. This is just a stock investment. So just to review that, 20% are 20 to 50 using the equity method. Our 50% presumes control. I'm not going to go back through all of these differences and things that might change control. We're not going to go through that. We're going to probably go directly here into, and I believe this is where we left off, was applying the equity method. So we're going to apply the equity method. We're going to use an example here where the acquisition cost of the investment was greater than the fair value of the net assets of the investee, and the fair value of those net assets was greater than the book value of those net assets. So Payne's going to acquire 30% of Sloan for $5,000. And we use small numbers in this. Sloan's identifiable net assets, so these are going to be assets less liabilities. Net assets, remember, we're always meaning assets minus liabilities in thousands. Fair value of our assets is $18,800. Our liabilities are $2,800. So the net assets are $16,000. Book value, $15,000 assets, $3,000 liabilities, net assets of $12,000. $5,000. Obviously, our $5,000 acquisition price is greater than 30% of $16,000, which is greater than 30% of $12,000. These are our numbers here where we do the computation. This is what we paid. The fair value of what we bought was $4,800. The book value of what we bought was $3,600. Does everyone see how we got those numbers there? Because this is important as we get into later computations kind of throughout this course in applying the equity method. Purchase price, fair value, or acquisition cost, fair value, book value. And so this has those differences. Okay, differences between fair value and book value. So we have a fair value of 16 and a book value of 12. the $4,000 difference, and this is always going to be just things that we're going to stipulate in problems and in examples. We'll just tell you what the differences are. 1,000 of undervalued inventories, so that's a minus. 200 of overvalued other current assets this year. 3,000 of undervalued equipment with a life of 20 years, and 200 of overvalued notes payable due in 5 years. That's our 4,000. Let's see, undervalued inventories, so we mark up inventories, undervalued equipment, we mark up. There's 4,000 overvalued current assets, that's a markdown. Overvalued notes payable, that's a liability that's higher than it needs to be. That's kind of a markup. These two offset. So the 4,000 is this plus this. Oh, let's see, this minus this plus this plus this. That's how we get to the 4,000. We'll make sure everybody kind of follows that. Maybe a little bit clearer with the journal entries. So at acquisition, Payne pays $2,000 cash and issues common stock with a fair value of $3,000. That's how it gets to its $5,000 that it pays for Sloan. It's got a fair common stock, got a fair value of $3,000 and a par value of $2,000. Payne also pays $50 to register the securities and $100 into the consulting fees. So the investment in Sloan, we book at our $5,000 acquisition price, for which we gave $2,000 in cash, $3,000 fair value of stock that gets recorded, $2,000 at par, $1,000 additional paid in capital. So that's our acquisition. Then we've got our investment expenses. There's the $50 to register the securities. It's going to go back against our additional paid in capital. There's our investment expense. It's going to go to the income statement, ultimately end up in retained earnings, and we pay out $150 of cash. So that's how Payne does the acquisition of Sloan stock, and that's the initial recording. The investment of Sloan, $5,000, and everything else falls out. Now, with the investment in Sloan of $5,000, we've already determined the book value of Sloan's net assets is $12,000, so 30% of that is our $3,600. So we have an excess of cost over book value of $1,400. We're going to go through and assign that based on this previous evaluation of Sloan's asset on these stipulated things here. These are 100% amounts. Now we're going to go and apply that to our share. So inventories, 30% of 1,000 is 300. And how are we going to amortize these differences to earnings? Some of them get amortized and some of them don't. Inventories, we're always going to assume that inventories acquired in acquisition are sold in the first year following the acquisition. It's a very simple assumption. You know, perfect world, assume efficient markets, no slow-moving inventories. All get sold the next year. Okay, our other current assets, 30% of a $200,000 downward adjustment is a $60,000 downward adjustment. This is also going to be first year. We're going to assume that that probably relates to overvalued accounts receivable would be the way that I think about it. Why is it a negative adjustment? They probably got overvalued accounts receivable, or they've undervalued their allowance for doubtful accounts, which is their contra asset account. Equipment, undervalued, so 30% of the 3,000, we mark up equipment. That equipment's going to get depreciated out over 20 years. We're going to be dealing with that adjustment for a long time in our consolidated financial statements. The note payable, again, overvalued, so we've got a debit there. By 200, 30% of that 60, that note has a 5-year life left. We're going to basically be amortizing that to interest expense. That's going to be our adjustment. So how these are going to be amortized: cost of goods sold, probably bad debt expense or sales, depreciation, interest, and then of course the balance is going to go to goodwill of 200, and there's not going to be an amortization for that. We'll assume we're a public company here. We're not amortizing goodwill. We're just going to measure impairment. This allocation process we will do again and again. Very, very important to kind of follow through how we did that. Okay, so we'll start our accounting now. We'll start our first year of operations, and Payne's going to receive $300 of dividends from Sloan. Okay, we'll debit the cash. When you get $300 worth of dividends in the mail, check comes in the mail, goes into the bank account, or it's an ACH these days. There's $300 of cash that comes in. Note that our credit is to our investment in Sloan. It's not to dividend income. We're applying the equity method here, not to dividend income. We're actually going to reduce our investment. Okay, then Sloan's going to report income for the year of $900. Payne's going to recognize its share, 30% of Sloan's income. So we'll start out with $300, but we're going to adjust that for amortization of the differences between book and fair values. So we're not going to really take in the $300. 30% of, I guess it would be, check me, 270. I always want to check me on my math. Don't let me do math in my head. So this is going to be our amortizations again. This is recapping the 1400 analysis that we did in the previous page. This is our first year amortization. We decided inventories and other current assets, probably accounts receivable, bad debt expense, going to go in full. Equipment's going out over 20 years. 900 divided by 20 means a $45 depreciation adjustment. Note payable is going to go out over 5 years. That means a $12 interest adjustment. And our adjustments that are going to be amortized this year are $297. So investment income is 30% of Sloan's net income minus amortizations. Oh, I'm sorry. That was unclear in the previous slide. 900 is
30% of the
is Sloan's share. Sorry about that. Okay. 30% of 3,000's 900 minus 297 is 603. 603 is the income that we're going to recognize, that Payne's going to recognize from Sloan this year. Not the 900, which is Sloan's unadjusted book income, but 603 because of these amortizations that are going to take place. Now you can see the first year amortizations are going to be large because of the items that we have. In future years, that difference is not going to be nearly as big. Not going to be nearly as big. So 603 is our number for the current year. And there's our journal entry. Entry is to debit the investment in Sloan, 603, and credit in our income statement. We now have an income statement item, which is our income from our equity method subsidiaries, income from Sloan, 603. Ending balance in the investment account ends up being cost minus our 300 of dividends plus our investment income ends up being 5303 at year end. Really important to understand this piece. I guess I got to make sure that doesn't keep blinking out. Really important to understand this piece because undoing this as we go into full consolidation is important. Undoing these, or understanding how these equity method entries have been made. In our examples, as we go into chapters 4 and 5, our consolidated financial statements will have this 603 of income, and we've got to figure out how they arrived at it and sort of back it out to do our full consolidation. That will become apparent in subsequent chapters, but it's very important to understand this piece. Okay, a little bit more on cost and book value assignment. On acquisition date, compare cost of acquisition, book value of net assets, and fair value of identifiable net assets, always. Cost of the investment includes cash paid, fair value of securities issued, and debt assumed. The book value of the investee's net assets, assets minus liability, or simply their stockholders' equity as of the date of the acquisition. These are the same number, as you know from our accounting equation. Assets minus liabilities equals equity. Fair values used in the assignment. Identifiable assets include all of the investee's assets and liabilities, whether they're recorded or not. There's going to be things that are not on the investee's books that we'll need to look at. Things like fair value of research in progress, fair value of contingent liabilities, fair value of unrecorded patents, or I think rather self-developed patents where you've expensed the costs of developing that patent. Yes, sir?
Sorry, jumping back a couple slides. One more. the amortized excess at year end, would that be kept on the balance sheet of Payne?
This is actually going to be kept as a work paper
So separate.
by Payne. Payne keeps this as an analysis work paper. A lot like, I would say it's very, very similar to like keeping a depreciation schedule. Here's what I did last year, what do I need to do next year with my adjustments? So this is kind of a subsidiary ledger. This doesn't really get booked anywhere on Payne's books as opposed to just maintaining this as a work paper, as a continuing analysis work paper until we're done with everything.
Okay.
So everything's amortized. And then our exception, which we mentioned earlier, use book value for pensions and deferred taxes. We're not going to have a lot of problems that have that. We just want to point that out as an exception. If cost is greater than fair value, just as a reminder, goodwill exists. If cost is less than fair value, a bargain purchase exists. And a bargain purchase gets recognized in the current period at acquisition. Okay, so let's do a bargain purchase example. When the acquisition cost is less than the fair value of the identifiable assets, a gain is recognized on the acquisition, and the investment's recorded at the fair value of the identifiable net assets. So we've got our investment in ABC here with what we paid. There's the cash, common stock, additional paid in capital. There's the consideration that we gave. To make our transaction balance, we recognize the gain on bargain purchase. So that's how we get there. Okay, interim acquisitions. We'll work on these later. There may be a problem or two that we have here in Chapter 2 and 3. We'll work on these quite a bit later in this course. Book value of net assets on an interim date, meaning this company has a calendar, our acquirer has a calendar year end. They buy somebody on June 30th, right? We're halfway through the year. Again, we're going to look at the book value of net assets as of the acquisition date. Is the book value equity as of June 30th, not as of the beginning of our fiscal year. If equity is given us at the beginning of the year, we're going to add current earnings and deduct dividends to date to get back to our correct equity. So we'll reset we'll take our equity as of the beginning of the year and then adjust it forward so that our net equity retained earnings reflect what they are at June 30th. Amortization for first partial year. In our examples, we'll take full amortization for inventory and other current assets disposed of by year end. Even if it's a short year, we assume that they're gone in that short year. We will leave life in reality, in the real world, for you to deal with slow-moving inventory and those other things. But in our examples, we'll always use full amortization, even for a short period. But we'll take a partial year's amortization for equipment, buildings, and debt to be written off over multiple years. We'll stay true to our GAAP consistency with depreciation. If we've got a short period, we're going to prorate our depreciation. If we've got a short period, we're going to prorate our interest adjustments. And we'll record dividends only if they're after the acquisition date. Dividends before the acquisition date are adjustments that we get to our correct beginning book value equity of the acquiree or the investee. Okay, acquisition in stages. You can go through phase changes over these. I don't know. There's probably a setting that I don't know how to do, but I guess I'll just have to keep an eye on this. You go through phase changes in acquisitions. Sometimes acquisitions are piecemeal and they're stepwise, and we buy this much of the company. We buy 20% this year, we buy 20% next year. As our ownership changes, goes up or goes down, our accounting has to change too, because remember, we're tied into accounting for cost or fair value if it's 20% or less, and equity method if it's 20 to 50. So it's step-by-step acquisition. Going from the fair value or cost method to the equity method will restate prior period statements. Investees' growth in retained earnings, excess of income over dividends declared. The investment account, desired balance using the equity method equals original cost plus share of growth in the investee's retained earnings and amortization, if any. So we're going to treat that as if we're going to restate prior period statements, and we're going to basically redo our fair value cost method accounting before we took that additional step. So the way that it's going to be accounted for is to increase the investment, debit the investment, and a credit to retained earnings.
How far back would you, like how many periods back would you restate?
Back to your original acquisition.
So if it was like a decade ago, you'd have to go back that far? Or is it kind of a limitation in terms of years?
In the examples we have, it's only going to be a couple of years. That's a good question. In the examples we have, it's only going to be a couple of years. But I think that the reality of it is that's what the FASB current text says. FASB 805 or 820. That's what it says as you restate prior periods. So it would probably be back to the beginning of the acquisition. So theoretically, if you've got a pretty substantial investment in an investee, you've got, like 15% or something like that. Obviously, you know a lot about that company. Hopefully, you're getting financial statements. You've got those records, or the investee is going to have those records. If they didn't have those records, you're just going to have to look at share of growth in the investee's retained earnings over that period. I mean, that's really kind of what your analysis is going to be. We won't have a lot of problems with that, but we point that out as an accounting issue with this. Okay, sale of an equity interest. So we have a sale of investment that's going to result in a lack of significant influence over the investee. Let's say we start out at 40%, but we sell 20%. We're going to convert from the equity method to the fair value or cost method, and that's going to be a prospective. So we pick that point in time, we make the conversion, and we're done. Our previous equity method entries we do not undo. For the sale, we're going to reduce the investment account to a proportionate share of the stock sold. That's our basis, if you think of it that way, and record a gain or loss on the sale. So here's the money we got for the 20% that we sold to reduce ourselves from 40 down to 20. We take half of our investment account, properly adjusted up to the date of sale, properly adjusted up for dividends and earnings. We take half of that, treat that as our cost, and recognize gain or loss. And then from that point forward, we're going to simply apply the cost method to the investments. 20%, as if it was never in the equity method once we've made this sort of correction moving forward. We will have some problems on this. Okay. Stock purchased from the investee. So if stock is purchased from the old shareholders, the percentage of ownership is based on the shares outstanding, and the investee's equity is not changed. This is an important point. Old stock versus new stock, right? If a company's got 100 shares outstanding and you buy 30 of them, you are now a 30% owner. You buy 30 of them from current shareholders, you are now a 30% owner. That's real simple. If it had 100 shares outstanding and you're buying 30 new shares being issued by the company, you're not a 30% owner. You're 30 over 130, right? So you're not a 30% owner. Acquired directly from the investee, obviously percentage acquired is shares acquired over shares plus previously outstanding, and the new stockholders' equity is the previous equity plus what you paid in for your new shares. So it's the previous equity plus the cash that you contributed. We have a problem in this chapter. Sometimes it's a little bit of a stumper in that sense, but you really got to think about what is your real percentage that you're acquiring of the company. Where an investee has a preferred stock, we compare the cost of the acquisition. If we're buying common stock, we compare the cost of the acquisition to the book value of the common stock. We will come back to this in later chapters. But total equity minus the book value of the preferred stock is going to be our book value of our common stock. The book value of preferred stock is its call value. A lot of times preferred stock is stated $100 par preferred stock, callable at 105. It's its call value plus any dividends in arrears if those dividends are cumulative, right? If they have to pay those dividends in arrears, you have to take that into account. When we get to doing consolidations with subsidiaries that have preferred stock, we will deal with this again. Again, dividends received will be a portion of the dividends to common shareholders. Obviously, total dividends minus current preferred stock dividends are going to be the dividends to common shareholders. It's only the dividends to common shareholders that we get a piece of. And investment income is based on income available to common shareholders. So that's going to be the investing net income minus the preferred stock dividends. And the current dividend if cumulative, or dividends declared if non-cumulative. So if it's cumulative means you got to pay the dividend no matter what. Non-cumulative means you pay it if you have earnings, right? So in a recession, non-cumulative company, they don't declare any dividends. Preferred stock doesn't get any dividends. And if it's non-cumulative, you don't have to pay them later if that's the way your preferred stock's set up. That's the way it is. So it's investing net income minus preferred stock dividends. That's the income that's available to common stockholders. And if you bought 30% of the common stock of the company, that's the income that you're entitled to, is just the income that's available to common stockholders, not the net income of the company. So just be aware, anytime that you have preferred stock, you need to make these adjustments because that preferred interest is a different interest than the common shares, and you have to account for it, and it's a priority interest. Okay, special reporting issues. If material, the investor continues separate reporting of extraordinary items and or discontinued operations of the investee. Income from the investee is based on income before discontinued operations or extraordinary items. We don't deal with these that much currently in GAAP. It's just something to be aware of. We really have very few extraordinary items anymore. Optionally, the investor may report its equity investments at fair market value under FAS ASC 825. So there is a fair value reporting option for its equity investments. I don't know that we see a lot of that out there in practice right now. We see the fair value option applied to certain other assets, not so much to equity investments. It just kind of makes it more complicated. Okay. In applying the equity method, our disclosures in our financial statements for significant equity investees, the name of the company, obviously the percentage that we own, our accounting policy, so we say very clearly we account for it using the equity method. The difference between the investment carrying value and underlying equity in net assets, so we'll disclose what some of those differences are. Aggregate market value of the investment, if known, and then summarized assets, liabilities, and results of operation. So if you can imagine this little footnote, we've got these explanations up here, and then we've sort of got a mini set of financial statements in our footnote. And I've done those footnotes, just summarized assets, liabilities, and results of operation. Just a basic sort of mini snapshot of that investee's financial picture. And of course, we'll make all of our usual related party disclosures under FASB ASC 850. Remember, related party disclosures, if disclosed, the auditor or the reporter does not have to substantiate that they were at arm's length. If they're a related party disclosure, you say, hey, this is a related party disclosure, may or may not be at arm's length. That's for you, the third party user, to decide. If you don't disclose, it's presumed to be at arm's length. So you always just make your related party disclosures. Goodwill impairment, we'll talk a little bit more about goodwill impairment. We've already talked about it some. But we test it annually for these acquirees, and if significant events occur, we take a two-step process. We take if the fair value of the whole reporting unit is less than the carrying value of the reporting unit, including its goodwill, there might be impairment. If there's no implied impairment, obviously we don't go on to step 2, and we'll use quoted market prices of the reporting unit if it's publicly traded, or valuation techniques applied to similar groups of assets and liabilities, so some form of appraisal or valuation is what we use for the acquiree. If the applied fair value of the goodwill is less than the carrying value of the goodwill, we'll record an impairment loss for the difference. So that's what's going to happen is when the fair value of the reporting unit appears to be less than what the carrying value is on our books, there might be an impairment. We'll go through that process. And if it really appears that we've got the implied fair value of goodwill after we've done our analysis and our evaluation is less than the carrying value, we're going to record the impairment loss. Remember, non-public company ability to opt out of the impairment model for goodwill and amortize. So if this was a non-public company, we wouldn't have to go through this exercise if we made the election to apply amortization to our goodwill. There was a 2011 amendment by the FASB that gives company the option of making qualitative evaluation to determine if the first step is needed. If it's more likely than not that the fair market value is less than the carrying amount, the company need not perform the two-step test. So they're simply saying, hey, if it looks like the reporting unit is at less than its fair value, just go ahead and just go directly to evaluating the impairment. You don't necessarily need to do the two-step test. Okay, goodwill implied in equity investments is not tested for impairment by itself. The investment itself is tested for impairment. So remember, always, 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 we're looking at the investment itself. We're testing it for impairment. If we've got recorded goodwill, then we're going to make the adjustment to the goodwill. So here's our example. Sam has a 30% interest in Lake. Investment in Lake has a carrying value of $4,200. This includes implied goodwill of $350. The $350 implied goodwill is not tested for impairment. If Sam's interest has a fair value of less than $4,200, an impairment loss on the investment itself in Lake is recorded. The unit itself is recorded. Is recorded. How can that impairment loss occur? Well, we find pollution on Lake's property. We've got pollution on Lake's property. There's an impairment there. Lake has a factory in Venezuela that just got nationalized, right? The government decided it was their property and took it under eminent domain. There could be different events and things that happen, and it's the impairment loss on the investment itself that's going to be recorded, not necessarily to the goodwill. Okay, the end of our chapter in the homework assigned. We've got 2 exercises that I think are not onerous, and then we've got a problem. This is due this midnight, Saturday of October 7th. I've mentioned to a couple of students that we also have the Chapter 3, which we're going to go to next, and we've got an hour and 15 minutes to go through Chapter 3. We've also got the Chapter 3 homework due next week. I want to get you the feedback before the next class. If you have a lot of conflicts with Meet the Firms and with other things going on in your life, I think I can probably if I'm going to show you a little bit of latitude in the homework, it's going to be for these first 3 chapters, simply because we're hitting the ground running. We've got a lot of work here, so I will show you a little latitude. I'd still like you to get it done so that I can get it graded and give you feedback. I was telling a student earlier that I took my annual fishing trip down to Tillamook on Sunday. And so when I got back, I had actual work to do in the office, and I did not get to the homework. I'm getting to the homework tonight, so I will give you feedback on Chapter 1 tonight. But I do like to keep the feedback because we're going to be into that exam here in the 4th week, and I want to make sure that everybody's clear. Please also, student called me tonight and said, hey, Mr. Howell, how about the office hours that start at 4 o'clock? If you really need to see me at 4 o'clock, do call me. We're dealing with October 15th deadlines at work. I do get hung up. I kind of forget where I am and what I'm doing. Okay. Let's move on to Chapter 3. And I will upload this corrected Chapter 2 where we made that one correction in the slide.
If you disconnect your charger, it can give you different power settings and it may not time out.
Okay. Good to know.
Yeah.
Let's give it a try. I hope it's still recorded. It seems to be, but I don't know. The screen went blank, so it kind of weirded me out a little bit. So, I'm not a Mac user. I explained earlier. I don't know if you were here that this was a hand-me-down from my son. But I was also told it's not such a bad machine, so don't be all kind of snarky about it either. So, okay. We've gone through the first 2 chapters, which is dealing with the investments in subsidiary, or the investments in stock of other companies. So that's all about accounting for the investments in stock. We've touched a little bit on consolidated financial statements. Now we're going to go into the introduction of consolidated financial statements. We will spend chapters 3, 4, 5, 6, and 7 on consolidated financial statements and recording entries in consolidated financial statements. Oh, the other thing I wanted to mention about the homework. Perfect homework, it need not be required to get full credit. Good effort is required to get full credit. Doesn't mean you have to have the right answer. You just need to send me something that shows that you tried. So I've had things that were like a spreadsheet with 4 numbers in them. That doesn't show me that you tried. Even if they're right, I don't see your process. So anyway, so we're going to recognize the benefits and limitations of consolidated financial statements. They have a lot of benefits. They have some limitations. We're going to understand the requirements for including a subsidiary in consolidated financial statements. Simple requirement is a parent may not present financial statements, its own financial statements, without consolidating all subsidiaries that are required to be consolidated. We'll apply consolidation concepts to parent company recording of the investment in subsidiary company at the date of acquisition and recording the fair value of the subsidiary at the date of acquisition. Will very closely parallel what we just talked about with the equity method. We'll learn the concept of the non-controlling interest when the parent company acquires less than 100% of the subsidiary's outstanding common stock. These are our 51 to 100%, where we have control, or we have presumed control, and we're required to consolidate, but we don't own 100% of the subsidiary. We've got that non-controlling interest. We used to call it a minority interest back in the bad old days. It's a non-controlling interest. Still an interest. They're still part of our stockholder group of the consolidated group of companies. They just happen to own stock of a subsidiary and a small piece of it. We'll prepare consolidated balance sheets subsequent to the acquisition date, including preparation of our eliminating entries. What are eliminating entries? We'll go through that. Substantially all intercompany transactions need to be eliminated. Substance over form. We'll amortize the excess of the fair value over book value in periods subsequent to the acquisition date, exactly as we did in our equity method example, where we had overvalued inventory, undervalued receivables. Very similar process. And we'll apply the concepts underlying the preparation of a consolidated income statement. Okay, business acquisitions, combination through stock acquisitions. We acquire a controlling interest in the voting stock, more than 50%, or may have control through indirect ownership. In other words, we own a subsidiary we own subsidiary A that also owns stock of subsidiary B. That's indirect control. We won't go into that in the accounting for that in great detail until we get beyond chapter 7. A business combination occurs once. Acquisition of additional subsidiary stocks, simply an additional investment, and it's going to decrease our non-controlling interest. But a business combination only occurs once, and so we'll talk about how we account for subsequent acquisitions if we're a 70% owner and we go to 80. Consolidated financial statements, benefits and limitations. They primarily benefit the owners and creditors of the parent. They are not primarily intended for the non-controlling owners nor the subsidiaries' creditors. They may not be meaningful to them. Those fair value adjustments may not be that meaningful to them because those are fair value adjustments that occurred as of the date of acquisition. Those are not today's fair value adjustments, right? So they have significance to the consolidated shareholders because they're accounting for their investment at fair value as of the date of acquisition. But these non-controlling owners, that's not that meaningful to them. Subsidiaries issue separate statements for the benefit of their non-controlling owners and creditors. A subsidiary may always present full GAAP financial statements of itself, and you simply say in the footnotes, we are a subsidiary of Payne Corporation. We're Sloan, we're a subsidiary of Payne Corporation. There's nothing wrong with that. Hey, we're a member of a consolidated group, but these are just our statements. So a subsidiary may always present their separate statements. A parent may not. A parent must consolidate all required subsidiaries. So what is a subsidiary? Simply put, a corporation becomes a subsidiary when another corporation acquires a controlling interest in its outstanding voting stock. So that's the common stock, not the preferred stock unless it's voting. In a 100% acquisition, the investee may continue to operate as a separate legal entity. So we may have a 100% owned subsidiary, but we didn't liquidate them. We kept them operating. They kept their name. They kept their own board of directors. They kept their own stock, even though we own all of the stock. Subsidiaries or affiliates continue as separate legal entities and prepare their own financial reports. So that's our presumption, is these subsidiaries were acquired, whether it was 100%, whether it was 70% or 51%, these subsidiaries were acquired and they continued their separate existence. Even the 100% owned subsidiary, if it's not being liquidated, it's presumed that it continues to operate as a separate or as a subsidiary company, keeps its own books and records. So the separate accounting assumption is something that is, and preparing their own financial reports, this is something that is a sort of a fundamental assumption in dealing with our consolidated financial statements. Okay, subsidiaries are consolidated, always. Cases where they may be excluded from consolidation, control doesn't rest with the majority owner. I mean, if you don't have control in fact, then you probably account for it with the equity method if you merely have significant influence. Some joint ventures don't have to be consolidated, but beware of variable interest entities, and we'll talk about those later. Those are the Enron Raptor partnerships, were our first variable interest entities that we all got slapped in the face with in this country. That's where the term comes from. You can have acquisition of groups of assets that do not constitute a business. You bought a factory, but you didn't get any of the customers, you didn't get any of the employees, you just bought a building with machines in it. That may not be the acquisition of a business. Or you took over a location. I mean, my favorite one is you are a Wow Burger franchisee and you took over a location that used to be a Burger King. You didn't acquire the Burger King franchisee's business. You acquired some assets from them and you filed off the Burger King serial numbers and put Wow Burger on it and continued. So acquisitions of groups of assets. Combination between entities under common control. Brother-sister corporations that have common ownership, high degree of common ownership. Maybe they're all owned by the same person. Those brother-sister corporations are not really considered consolidations. We have a little bit different accounting for them that we'll talk about. It's very similar to our old pooling of interests, just add the balance sheets together. So we don't go through the fair value analysis. And then combination of not-for-profit entities or acquisition of a for-profit company by a not-for-profit entity. This does happen. We have a for-profit entity in our firm that's owned by a nonprofit. We only do taxes for them, thank God, but we do have that, and that isn't, you don't put apples and oranges together. A nonprofit, you can't consolidate in a profit entity. That's just not done.
Does the, I know it's a factual question, but does the not-for-profit entity, when it buys a for-profit company, lose its not-for-profit election?
It can depend. It can depend. So let me give you the example of our company, of our client. So our nonprofit client is interested in, they're interested in getting, cooking equipment for healthy food preparation, safe food preparation into the less developed world, right? So into areas where maybe they don't have an electrical power grid and they can't just buy an electrical stove to plug in, and people are trying to get away from burning wood and charcoal and things like that to cook with. And so they have a for-profit company that manufactures solar-powered stoves and solar-powered cooking equipment, which is really kind of cool stuff if you think about it. I think about it a little bit for just camping, if it wasn't so heavy. But it's more like you want to sell somebody's going to set it up in their kitchen, but they don't have to plug into the electrical grid to do it. That for-profit company supplies those stoves and that cooking equipment at cost to the nonprofit entity, which then, as its charitable mission, takes those to other parts of the world and distributes them and goes through aid agencies and through governments in other parts of the world and says, hey, let's get these out to the people. but they also sell them for profit in the for-profit market. So in that particular instance, the nonprofit entity doesn't have a problem with it because their purpose in acquiring the for-profit company was to obtain an economic supply of equipment, basically, that they use in their charitable, activities. It's a little bit different, and this is beyond the scope of this class, but generally when nonprofits go into competition with a for-profit entity, then they start having problems with what's called unrelated business taxable income. So an example that I'll give to you of that, there's a famous tax case, and it is Commissioner of Internal Revenue versus Portland Golf Club. That's what happened right here. And Portland Golf Club used to host the Peter Jacobson Challenge, and Portland Golf Club was also organized as a nonprofit, not as a charity, but as a nonprofit athletic club. The members, you pay your dues, and it's just sort of a pooling of resources so that you can have this nice golf course that you all share. Yeah. And what they wanted to do was they wanted to say that, well, our dining room loses money because we don't charge our members enough money for food and for booze and things like that. So our dining room loses all this money, and we want to offset the profits of the Peter Jacobson Challenge against we want to basically say that that's going to offset our nonprofit losses. And the IRS said, no, you need to pay income tax on your profits from the Peter Jacobson Challenge because that's a for-profit activity. You're competing with for-profit, golf courses, Heron Lakes, corporate-owned. You're competing with for-profit businesses. You're carrying on an activity that's in competition with private industry. Very, 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 very tough to do. But it can be as simple as a cell tower on top of a church building, right? We have that. Church building, they put a cell tower on it. Verizon or whoever pays them for the cell tower. That's unrelated business income. Unrelated business income. Okay. Okay, consolidated financial statements prepared by the parent company. Parent discloses their consolidation policy. There's an SEC regulation, SX, on that. Any exceptions that they have to consolidation, we're not consolidating this subsidiary because we don't have control, because it's subject to substantial control by a foreign jurisdiction, etc. Fiscal year end for the consolidated entity will use the parent's fiscal year end, FYE, fiscal year end, but may include subsidiary statements with a fiscal year ending within 3 months of the parent's fiscal year end, and will disclose intervening material events. So we can consolidate in our September 30th subsidiary into our calendar year financial statements and pretend that they have the same year end. We get to do that. We don't have to do short period accounting. We can, but if we do that, it's an accounting policy that we have to disclose, then we have to be consistent moving forward. So we can do that, but we're not required to do it because of this 3-month rule. But we'll need to disclose intervening material events. Like fourth quarter, our subsidiary lost more money than it made in the previous year. That would be a material event that would need to be disclosed. Okay. So we'll go through an example here of consolidated balance sheet as of the acquisition date. So our parent in this example is Penn. Its acquisition cost of its subsidiary is equal to fair value, and it's equal to book value. So we'll start out with the simplest possible example. There's no fair value differential, and there's no book value differential, right? So our acquisition cost, we basically paid book value for this, and none of their assets are undervalued or overvalued. Doesn't happen in reality, but we'll start with a simple example. So Penn's going to acquire 100% of Cell for $40, which equals the book value and fair value of the net assets acquired. Here's Cell's balance sheet, and we're saying book value is equal to fair value. And you can see that our net assets, 65 minus 25 is 40, or capital stock and retained earnings are 40. Book value equals fair value. So the cost of acquisition is $40, less 100% of book value, so our excess of cost over book value is obviously 0. So to consolidate, we'll eliminate Penn's investment account and Cell's capital stock and retained earnings. So this is going to be a very, very simple example. Here's our separate financial statements. You'll notice that Penn has its investment in Cell there at $40. Here's Cell's balance sheet. We don't have any fair value differentials. And we simply add across to get our consolidated financial statements. You'll notice the investment in Cell, there's an adjustment. There's an adjusting entry here. The investment in Cell disappears. That goes away. We add all the other assets, and you'll notice that the capital stock and the retained earnings that come across are Penn's. This is the other part of our eliminating entry. So the investment's eliminated. Got a little animation here. And Cell's equity is eliminated. Only Penn shareholder equity remains. So these columns are actually not added across. Any questions on this example? So we're eliminating the investment in the subsidiary against the subsidiary's equity. And we will continue to do that.
So are there actual journal entries for that, or we just don't worry about it when we stop the stuff?
Actual journal entry.
Okay,
You'll make an actual journal entry. You're eliminating journal entries.
okay.
And we'll go through our suite of 7 eliminating journal entries, I think, next week. Okay, again, cost, fair value, and book value, these concepts that we continue to deal with. In real life, they're never really all the same as in the previous example. So acquisition cost, fair values of identifiable net assets, and book values on the books of the acquired subsidiary are going to differ. I mean, that's our reality. So we'll allocate the excess or deficiency of cost over book value and determine goodwill, if any, as we've been doing in Chapter 2. When book value is equal to fair value and cost is greater than book value, the excess is goodwill. When cost is less than book value, the excess is a gain on the bargain purchase. Review, talked about these concepts before. When none of them are equal, the difference between the book value of net assets and the fair value of identifiable net assets is assigned to the specific assets or liabilities, meaning undervalued or overvalued inventories, plant assets, unrecorded assets. Same types of things we've been talking about. Difference between fair value and cost is goodwill or a gain on the bargain purchase. So goodwill can arise in a couple of different sorts of circumstances. So let's go through an example where book value doesn't equal fair value, but cost equals fair value. So this is Piper and Sandy. So Piper's going to acquire 100% of Sandy for $310. Cost minus fair value is 0. Okay, fair value is 385 of total assets minus 75 of liabilities is 310. So we basically paid fair value of net assets. There doesn't appear to be any goodwill on this acquisition at all. Book value 100 plus 140. Wait a minute. Let's not say there doesn't appear to be any goodwill. Book value 100 plus 145 equals 245. Book value and fair value, we've got some differentials here. We've got a differential in inventory, and we've got a differential in plant. There's our cost of the investment was $310. That's the book value on the books of the subsidiary, so there's our excess of cost over book value, $65. Here's where our numbers come from for these items. So continuing with this example, we've got our $65 now. We're going to allocate it to inventory. We saw that on the previous sheet comparing book value and fair value. $25 all gets amortized in the first year, and then the remaining $40 to the plant. That's going to be amortized over 10 years, so that's our total. We've accounted for our total. Yeah, there is no goodwill in this example. I didn't want to get ahead of myself. No goodwill in this example. Piper's elimination worksheet entry. We're debiting the capital stock of Sandy, crediting the retained earnings of Sandy. We're debiting capital stock and debiting retained earnings, which removes those. We're debiting our inventory to write it up. To acquisition cost, we're debiting our plant to write it up, and we're crediting our investment in Sandy for 310. Any question about this basic elimination entry? Again, we're eliminating the equity of the subsidiary against the investment account, and we're recording our differentials as part of that, our fair value differentials.
I do have a question.
Yes.
So for the plant assets that are undervalued there, that's amortized over 10 years? Okay. So I thought it was 40, so I'm a little confused by that.
Oh, in this particular case, we'll have that in a lot of different examples, and so we'll have different lives. They're just going to be assigned in the problem, depending on. Sometimes it'll be buildings. Sometimes we'll say they're 10. Sometimes we'll say they're 20, and that's basically an evaluation that takes place at the acquisition of saying, hey, we got this building. We feel that there's a fair value differential here. What's its remaining useful life, right? We can look at how the subsidiary has been depreciating it. More likely what we'll look at is we'll sort of take a fresh view and say, hey, how long do we think that this building's going to last? What's the acquirer's, what's the parent's policy for how do we depreciate buildings? We're going to give a similar life to what we give to used buildings that we acquire, that sort of thing. So that's just going to be stipulated in the problems, Robert, and that's going to change, from problem to problem. So we're not going to use it's not neat and clean like tax where we always use the same depreciation life. These will be a judgment call that we'll make at each acquisition.
Thank you.
Okay. So we'll go through another example here where book value doesn't equal fair value and cost is greater than fair value. So we're going to have Panda acquire Salty for $530. So these are Salty's balance sheets here. Here's its book value. Here's its fair value. You can see we've got some fair value differentials here in plant and also in liabilities. The fair value of its net assets is $495. And the cost of the asset, we're paying $530 for $495. So we've got 35 of goodwill that we're going to recognize as one of our differentials. There's our book value, 250 and 190. So again, showing you where we take those numbers from. There's our book value. It's basically just the book value equity of the subsidiary of Salty. There's our fair value, comes from our fair value column. Fair value of net assets is $495. We've got an excess of cost. That's what Panda paid, was the $530. There's the book value. There's the $440. So the excess of cost over book value is $90. Now we go through and do our allocation of that $90 to what we got. So we've got the plant. We decided that fair value of that was $60 more than book value. The liabilities were $5 less. These are our amortization periods. You can see there our plant, we end up with 4 years in this example. No particular rhyme or reason, just a stipulated fact. And there's our goodwill for 35. Panda's elimination worksheet entry, when it's doing its consolidation, we'll get rid of the capital stock and the retained earnings of Salty. That's the 440. There we record our differential on plant and on goodwill and on liabilities, and we eliminate our investment in Salty. A very simple elimination entry to bring our balance sheets together. Okay.
So just to confirm, the amount that we're allocating from the goodwill or amortizing, it's always the difference between the book value and the fair value, correct? So
It's the difference between the cost of the identifiable assets and the fair value.
okay.
Yeah, so it's the cost of the investment less the fair value of the net assets. So here our cost is $530, our fair value is $495. That's how we get to the 35 of goodwill. So the difference between what we paid and the fair value of what we got. that we can identify, of the identifiable assets, the difference goes to goodwill.
Thank you.
Yeah, it's easy to get lost in the goodwill,
Just trying to.
in the goodwill woods, yes.
Yeah.
Okay, now here's going to be an example where we've got book value doesn't equal fair value, and cost is actually less than fair value. So print's going to acquire 100% of sum for 185. So that's our cost. Our book value is 180. 75 and 105. This is our book value balance sheet of sum as of the date of acquisition. So we've got 180. Did I do that right? Yeah. Okay. Our cost was 185. Here's our fair value is 210. So cost minus fair value is going to be a $35 bargain purchase. There's our fair value. There's our book value. There's our fair value. There's our cost is 185. Cost minus fair value is going to be a $35 bargain. 25. It's 25, isn't it?
Yeah.
It's 25. Nice.
It's okay, the reason is to do.
I just want to see it if our, yes, it's 25. See how editable that is. Thank you. Oh, we're going to get all these slides fixed. Okay. So now I get to re-upload chapter 3 too. Perfect. Okay. Okay. So there's our allocation, inventory, plant, and our bargain purchase. Comes down to our net of 5. The inventory and plant numbers, right here. Inventory book value of 80, fair value of 90, plant book value of 100, fair value of 120. That's where those come from. Our bargain purchase is a gain. That's our total difference is the 185. So print's going to record the acquisition of sum, assuming a cash purchase as follows. Note that the investment account's recorded at its fair value, and the bargain purchase is treated immediately as gain. So this is the recording of the investment. So we assume that we pay 185 cash for it. We're booking the investment at 210, and we're going to recognize that bargain purchase immediately as part of the purchase transaction. Right there. Okay, then our worksheet elimination entry. Our unamortized excess was 30. It's $10 for the undervalued inventory. It's 20 for undervalued land, included plant assets. You know, land isn't depreciated, so there's not going to be any amortization of that. So Prince elimination worksheet entry, we get rid of the subsidiaries, capital stock, and retained earnings. We're going to use a clearing account in this example called unamortized excess. That's just a clearing account that we're going to clear out. So we're using that just for clarity here, because we want to get our journal entry to balance. We know we paid $210 for sum. We know that this is sum's book value equity. So right now we're just going to use the clearing account for the unamortized excess. So we've kind of split up the journal entry here. We didn't have to do that. We could have put these up there as our debits, but we're just doing this for clarity purposes. Then we go through and then out debit inventory for 10, debit plant for 10, and credit our amortized access, and that goes away. That clears out. So that's just shown as a clearing account, just for convenience. In problems, if you find it easier to use an unamortized excess account, go ahead and do it. Sometimes the problem sort of calls for it. If you don't do it, I won't mark anything off. I mean, if somebody gave me this journal entry, 75, 105, 10, 20, and a credit of 210, it's fine. You don't have to use that, but it's just really used for clarity here. It's a clearing account. It's nothing that ever ends up on our consolidated balance sheet.
So why did that problem have eliminating entry but the previous two didn't? Or did I miss something?
They all had eliminating.
Oh, okay. I meant the worksheet is what I meant to say. I'm sorry. Or did I? Okay.
Yeah, we didn't go one step further
Okay.
to the worksheet. You're right. Yeah. So there's our worksheet with printed sum, and this is actually us recording. This is actually us recording then that that entry that we talked about. In and out of the unamortized excess, I keep saying excess account, nothing comes over to the consolidated balance sheet. We eliminate the subsidiary's equity, we eliminate the investment, and we book up our inventory and plant of sum to their fair value. Pretty straightforward, I hope. Okay, so we'll talk a little bit now about non-controlling interests. This is where the parent acquires less than 100% of the voting stock of the subsidiary, or, pardon me, as we'll see in later chapters, can be where they acquire 100% of the voting stock, but there's preferred stock outstanding that they don't acquire. So those are going to be non-controlling interests. Non-controlling interest represents the minority shareholders. It's a part of our stockholders' equity. It's a part of our consolidated stockholders' equity. It doesn't go away. But it's measured at fair value based on the parent's acquisition price. So remember, when we're doing an acquisition and we're revaluing assets and we're doing full consolidation, this is where it's a little bit different than the equity method. Is we're applying those fair value adjustments to 100% of the assets. And one of our balancing entries that allows us to do that is then recognizing the non-controlling interest in our consolidated financial statements. It's going to be measured at fair value because we've made 100% of the fair value adjustments in the net assets, meaning that, and we've adjusted our investment to fair value, but we also are going to adjust the minority interest to fair value and call it the non-controlling interest. So let's go through an example here. Parent pays $40,000 for an 85% interest in a subsidiary. The implied full value, and this is important, the implied full value of the investee is $40,000 divided by 85. It's really $47,000. We're only buying 85% of it, and we're paying $40 for that. That's the, but that's the implied full value. Yes.
Wouldn't the minority amount be worth less though, because there's no control over the corporations?
That's a very, very good point. So in the real world, we always apply discounts to minority interests when we're doing valuations for lack of control, lack of marketability, other restrictions. In our consolidation model, we don't. We treat that minority interest, those minority shares in the subsidiary, the same as our shares. In other words, we give them the same value. So if ours is worth, if we own 80% and ours is recorded and worth 80 at acquisition, we're going to record the minority interest at 20. Always, but it's a very good point, because normally we think of minority interest, and if we worked in that area at all, start thinking about discounts, valuation discounts. We don't do that here. Full value given to the minority interest. So in this case, our minority share is 15%, which is going to be the $7,059. It's real simple. Here's 85%, here's 15%. Total value of the acquired subsidiary is $47,059. So any question about that? This implied full value is something that we will deal with again and again where we have a less than 100% acquisition. We've got the implied full value. We go through and allocate 100% of the fair value adjustments to the assets, to the net assets, to the assets and liabilities of the acquired subsidiary. We mark those all up to fair value, and we account for it with our investment and with the non-controlling interest, which is a component of equity. Okay, an example for the non-controlling interest. So Popo acquires 80% of Sign for $400 when Sign had capital stock of $200 and retained earnings of $175. Sign's assets and liabilities equal their fair value except for buildings, which are undervalued by 50, and buildings have a 10-year remaining life. So here's our cost of 80% of Sign. 400 divided by 0.8, or 80%, is going to say the implied value of Sign is 500. Book value, its net assets, which are the same as its stockholders' equity at book value, are 375. So the excess of cost over book value is 125. We're allocating 50 to the building, which we just stipulated that in the problem. 50 of it's to the building. Our residual allocation model, 75, is going to go to goodwill. There's our total 125. You'll notice that we are recognizing not 80% of the markup, but 100% of the markup of the building to fair value and 100% of the goodwill. Our non-controlling interest has a piece of that, and we will see that in a moment here. There's our elimination entry. Here's the capital stock of sign. The retained earnings of sign go away. There we book up the building and the goodwill. Our investment in sign was 400, and you can see that our other adjustment entry is to establish our non-controlling interest, to recognize a non-controlling interest in our financial statements. Our non-controlling interest was here. They had 20% of this. They were here, but we got rid of all of that, right? We got rid of all of Sign's equity, but we have to give them an accounting in our stockholders' equity section. So we have to account for their 20%. It is a component of our consolidated stockholders' equity, our non-controlling interest. Yes.
So is that actually an account that sits on our books?
Yeah, it's an account that appears on our final balance sheets of our consolidated entity.
What kind of account is that?
It is an equity account. It follows capital stock, capital and preferred stock, retained earnings, non-controlling interest. It's going to be in our stockholders' equity of our consolidated financial statements. Very real account. A new account that you have not seen before. Here before.
That's why I asked.
Yes, it is an equity account you've never seen before, and that appears on our consolidated financial statements. You can always tell when you're looking at a set of consolidated financial statements, even if they don't have consolidated at the top, if they have a component in equity, if they have a line item in equity that says non-controlling interest, you know you're looking at a set of consolidated financial statements. Yes?
Would non-controlling interest typically be considered preferred stock possibly, or is it completely separate?
It's completely separate.
Okay.
Really what it represents in most cases, and in this example here, is it represents common stock of the subsidiary, but revalued as of our date of acquisition. That's really what it is. Now, when we get into later chapters, we'll deal where we have the non-controlling interest common and preferred, right? Where we bought 80% of the common and none of the preferred. And we have to account for both. We have to account for basically two non-controlling interests. And actually, in a set of consolidated financial statements, those may appear as separate components, either on the face of the balance sheet, stockholders' equity section, or in the footnote explaining the non-controlling interest. So if the subsidiary had preferred stock outstanding, there may be two pieces, but we won't deal with that right now. We're just going to deal with common. Okay. So then these are our worksheet entries for Popo and Sign to go ahead and record those adjustments. So you can see we're booking up our building and our goodwill. We're getting rid of the capital, all of the capital stock and all of the retained earnings of Sign. 100% of the fair value differentials of building, 100% of the goodwill determined based on the implied value of Sign of $500,000, right? 500. There's our investment. There's our 80% investment that gets eliminated. Nothing goes over to our consolidated balance sheet. And then here's that non-controlling interest. 20% of the fair value as of the date of acquisition. $100. It's over here, and you'll see it's in our stockholders' equity section of our consolidated balance sheet. That appears there. It's a very real component of what we're dealing with. Okay, consolidated balance sheets after acquisition. So in preparing the consolidated balance sheet post-acquisition, we always eliminate, as we have in the previous examples, eliminate the parent's investment in subsidiary. We'll eliminate the subsidiary's equity accounts in their entirety, common stock, retained earnings, etc. Those are completely eliminated. We'll adjust our asset and liability accounts for any unamortized excess balance. So any unamortized values that we still have in years 2 and year 3, right? That was your question about those work papers. Do we keep those work papers, those differential analysis work papers? Yes, we do. We'll record our goodwill, if any, and we'll record our non-controlling interest, if any. We'll always have a non-controlling interest unless we do 100% acquisition of all the stock of the subsidiary. All stocks, all classes. We will always have a non-controlling interest. So let's continue our example of Popo and Sign for balance sheet after acquisition. Just to recap, our cost was $400,000 for 80%. Our implied value, therefore, was $500, which is 400 divided by 80%. Our book value was $375. We had an excess of $125, which we allocated to building and goodwill. So here's our unamortized excess work papers. Sort of our think of it sort of like your consolidated depreciation schedule for all of your consolidated assets that you're tracking. You have these differentials. So our beginning unamortized excess, we never amortized goodwill, so there's never an amortization on that. And our building is getting 10-year amortization in this example. So current year amortization is going to be 5, and our ending unamortized excess is going to be 45. Does everybody see that? So we're going to have an adjustment to depreciation on our consolidated financial statements. And here's where we are after 1 year. Those are our assets, liabilities, and stockholders' equity. We acquired Sign, but Sign continued to keep its books on its historical basis and went forward another year in operations. Its retained earnings, I think in the original example, were $175. You can see they made $10 net, whether they paid dividends or not. Their retained earnings increased by $10. Okay, so this is a year later. This is a year later. So Popo is eliminating worksheet entry. Again, we're eliminating the capital stock of Sign. We're eliminating the retained earnings of Sign, the current retained earnings. We've got our unamortized excess, which is the 120. And we've got our investment in Sign and our non-controlling interest. These are now different numbers as of the end of the year. But they retain their proportionality, 80-20. Why are they different? Because we've amortized some of the excess and Sign had some earnings. That's why. That's why it's not 400 and 100 anymore. There's our building and our goodwill and our unamortized excess. We go ahead and make the entry for those. And these are our consolidating balance sheets. This investment in Sign, our controller at Popo continued to account for Sign using the equity method. As they got the dividends, they debited cash and they credited investment in Sign, and they booked our share of Sign's earnings, our 80% of Sign's earnings as adjusted for the amortizations. So we always trust, in most cases, our controllers, in this class, we trust our controllers of the parent company that they're doing a good job with that. Unless the problem tells you otherwise, that they forgot something. And the problem will tell you if they forgot something that you need to fix. There's our adjustments. So we eliminate our investment in Sign. We eliminate the stockholders' equity of Sign. We record our differentials. And we record our non-controlling interest. And there's our ending balance sheet as of the end of year 1. You'll notice that the building is now 45 because we've taken $5 of additional depreciation to our consolidated financial statements. We haven't flipped over to the income statement side, but you will see that when we do that. You'll see that when we do that. And there's our consolidated financial statements. Our investment grew from 400 to 404. It got eliminated in our consolidation, but our non-controlling interest has now grown from 100 to 101. Okay, consolidated balance sheets after acquisition. Key balance sheet items. The investment subsidiary does not exist on the consolidated balance sheet. Always, always, always goes away. As you're working these problems and it's not going away, it's because you've missed something. And believe me, we all miss things. I work some live problems in class, and it's like, okay, what did I miss, right? You know, it's easy to miss things. But if it isn't disappearing, then you know that you missed something and you want to look at that. Equity on the consolidated balance sheet consists of the parent's equity plus the non-controlling interest. the subsidiary's equity completely goes away. A little piece of it remains on there as a non-controlling interest, but our entry is to eliminate 100% of the subsidiary's equity accounts. The controlling interest is proportional, and it continuously retains that proportionality, in most cases, to the investment in subsidiary account when the equity method is used. This is how that 101 equals the 404 proportionality, the 2080 is maintained here. Total fair value equity of signs 505, 20% of it belongs to the non-controlling interest, 80% of it belongs to 404. We can also get there mathematically by taking 404 times 20 over 80. Okay, and I'm just curious where we are in this here. Okay, we're doing good. Amortization after acquisition. So the unamortized excess, which results from our acquisition cost being greater than the fair value of net assets acquired, the excess is assigned to assets and liabilities and amortized according to the account. So these are our balance sheet accounts. We've already talked about inventories and other current assets. Generally, we're going to amortize those. Those are going to be adjusted through consolidated income in the first year. They'll go to inventories, are going to go to cost of sales, and the differences in other current assets we'll just put in other expenses. We're not doing real granular accounting in these consolidated financial statements. We're dealing with summarized numbers here, okay? But probably bad debt expense if it's a receivable thing. We'll put them to other expense in our examples. Buildings, equipment, and patents. The amortization period is going to be the remaining life at the business as of the date of the business combination. So we evaluate what the remaining life is, and those will come through as adjustments to depreciation and amortization expense. Remember, when it's an overvalued, when cost is higher than the fair value of the building, it's negative depreciation expense, right? It's basically negative depreciation expense because we've recognized that building at a lower fair value that's carried on the books of the subsidiary. So depreciation adjustments can go both ways. They're not always an increase to expense. Okay, land and copyrights, those don't get amortized. Long-term debt, and we're talking specifically about note payable issuances here. That's almost exclusively what we're talking about. It's time to maturity and the adjustments to interest expense. That's where those fair value amortizations go to. So we'll continue the example of our friends Piper and Sandy here. Back to our original example where the cost was $310, 100% of book value was $245, the excess was $65, and it was allocated this way. The inventory and plant. Here's our analysis work paper for our fair value differentials. Beginning amortized excess was $65, taking the whole amount of inventory to our consolidated cost of goods sold. It's going to be an increase in our consolidated cost of goods sold, a decrease in profit in the first year. Plant's a 10-year asset, so we're taking $4 of additional depreciation. Our ending amortized excess then is just the plant. It's just the remaining 9 years of the plant. You can see eventually the plant's going to go away too in this example. This example has no goodwill, so after 10 years, we're done with this. We fold up these work papers and put them away. So we'll continue, then also continuing the example of Panda and Salty. That was where our cost was $530, the book value was $440, our excess was $90, and it worked this way. So the liabilities were negative $5 over 5 years. Those were our beginning unamortized excess. This is how we amortized them. Our plant was over 4 years, so a $15 increase in depreciation expense on the consolidated statements. With our liabilities, it's a $1 decrease in interest expense because we felt those liabilities were overvalued, and our goodwill just stays on the books. Goodwill will just stay on the books. That will never go away unless it becomes impaired. And we'll continue, lastly, the example of print and sum, where we had a cost of $185 a book value of 180, and we had our bargain purchase. Bargain purchase gets recorded immediately at acquisition. We don't fool with it here in the amortizations, obviously. So we just have the inventory and the land. The inventory goes immediately to the income statement in the current year. Any unamortized excess is to land. We're kind of done with carrying these work papers forward. That was a one-time thing. We wrote off the inventory. The land's going to stay on the books. There was no goodwill. That bargain purchase went to earnings the first year, and we're kind of done. Print and sum would be a simple consolidation moving forward because we're done amortizing things completely. There is no goodwill. So let's go through a comprehensive example, and then that'll be good for this class. So PIL acquires 90% of SAD at the end of 2011 for $10,200. When SAD's equity consists of 4,000 common stock, 1,000 of other paid-in capital, and 900 of retained earnings. So 50, it gets 90% for 10.2. The book value of net assets is $5,900 altogether. On that date, SAD's inventories, land, and buildings are understated by 100 inventories, 200 for land, and 1,000 for building, respectively. Its equipment and notes payable are overstated by 300 and 100. And I think we have some goodwill here too.
And I can just back up a second. How do notes paid and get overstated or understated?
Because we're going to adjust them to fair value based on their interest rate. And if at their issue date the interest rate was over market, then they're overvalued. We're going to mark them down.
All right. Go ahead.
Kind of like the old fair value, present
Yeah,
value stuff from 211.
I'm still, in my head, I'm still used to just evaluating bonds based on cash flows and not and forgetting that the market rate moves, so.
Yeah, and the gap accounting for discounts and premiums. This is a lot like bond discount and premium.
Yeah.
The way that we account for that in financial statements, where we buy bonds, where we're a purchaser of bonds in the secondary market, and we've got to amortize premium and discount.
Yeah.
It's sort of the same concept.
Yeah, no, I get it now. I just forgot that fair value, you've got to take the market rate into consideration.
Yep.
Everything's clicking now.
That's where our valuation adjustment comes from. That's the presumption there. Is there's a rate differential. Okay. So we're paying 10.2 for 90% of SAD. So that's going to be our implied fair value is going to be the 10.2 divided by our 90%. It says the implied value of SAD is 11,333. We know the book value. We added those up on the previous slides. That's 5,900. So we've got an excess over book value. We've gone through our allocations. We've stated what all those were, and we're going to end up with a big piece of goodwill when it's all said and done. So allocated to inventory, land, building, equipment, and note payable exactly as we said here in the previous slide. That's where all those numbers came from. Those are just stipulated in the problem. Okay. So we've got our excess valuation or our unamortized excess work paper here. These are our beginning unamortized excess. Our current amortization, inventory always goes to earnings the first year. Land never gets amortized. Goodwill never gets amortized. So building, equipment, note payable will all get adjustments. The note payable, in this example, we made it simpler. There's only 1 year left until it was retired. So it's an immediate adjustment, but that could be 4 years. More realistically, we would say it's 4 or 5 years. But in this particular example, that just happened to be that way. Now we'll take a little bit of a look at the income statement effects of some of this. So here's our sales for PIL and SAD, our separate sales. And you'll notice that we've got that component in there from our equity method accounting, which is income from SAD. So our controller at PIL has recorded the equity method income of SAD, and they've actually done it correctly. That is 90% of the adjusted book income of SAD, adjusted for our fair value amortizations. Cost of sales, you can see that we've got an adjustment column. A student pointed this out to me earlier. We've got an adjustment column that isn't here, but there's our $100 debit to cost of sales. We've got our $25 debit there to depreciation for building. We've got our $60 credit to depreciation expense for the equipment, which was overvalued. No adjustments to other expense. And then we've got our $100 adjustment here to interest expense, right? To come down to, these are our separate net incomes, but you'll note this includes the income from SAD. There's SAD's income, and there's our total consolidated income. Is this column 3158? However, this is the part that belongs to the non-controlling interest share. This is 6350. $571.50 and $63.50. $635, 10%, $63.50. 90%, $571.50. Everyone see that relationship there? Pre-adjustment net income of SAD 80. We throw in the inventory, the depreciation adjustments, the interest adjustment. This becomes 630. That's where the 630 comes from. Not that apparent from this slide. If we take the 800, we subtract the inventory of 100. Depreciation, the building depreciation was 35. The depreciation on the equipment was a plus of 60. Interest expense was a minus of 100. I think we get to our 635. 700, 760, 25. I'll have to check and make sure that works, but that's basically where we're supposed to get. Okay, so looking back at this income statement, key income statement items, and we don't see the entries on this, but we will see them soon enough. The income from the subsidiary account is eliminated. Income from SAD, this $571.50, it doesn't come over in our consolidated financial statements. There's an eliminating journal entry column where that goes away. And we're just not going to go there yet, but we'll go there soon enough. Okay, current period amortizations are included in the appropriate expense accounts. So we've adjusted depreciation expense, building, equipment, and interest expense with their current period amortizations. The non-controlling interest share of net income is proportional to the income from subsidiary under the equity method. 635 is the adjusted income of the subsidiary in this example. 10% of it belongs to the non-controlling interest. 90% of it belonged to the control. Any questions on that? We will go through a lot of problems that deal with these concepts, and this really becomes the core of our accounting and our entries that we do in chapters 4, 5, 6, and 7. So for the next 4 chapters, this is really the core of how we do those preliminary calculations based on the facts that are given to us to determine the consolidated journal entry. So this is meant to be an introduction here and introduce the concepts. I'm going to mention this briefly here because the text mentions it. So those of you that have been diligently reading the text in detail, there is this thing called push-down accounting. We're going to push out push-down accounting to the end of the course. But basically what push-down accounting is it's a SEC requirement where the subsidiary is substantially wholly owned, approximately 90% or greater. There's no publicly held debt or preferred stock. There, the SEC says when you present the books of the subsidiary, push those adjustments, those consolidated adjustments down onto the books of the subsidiary. Mark up their inventory, mark up their fixed assets, or mark down their debt, whatever you're going to do. All those fair value adjustments are pushed down on the books of the subsidiary. So they're revalued based on the acquisition price. Retained earnings then is replaced by yet another equity account that you've never seen before called push-down capital, which includes retained earnings and those valuation adjustments. We're going to review this in detail in Chapter 11 at the end of the term. I mention it here only because it's not part of our first exam. We're not doing any problems on it. The authors mention it here, so I mention it here in the slide, but we're going to deal with it. It's not a concept that we're ready to focus on at this point in time. So I just point that out that it's there, just because I think that I need to. I'm going to skip this slide. This gets repeated in chapter 11, but it's really what it is it's a fresh start, new existence concept for that either wholly owned or substantially owned, 90% plus owned subsidiary. Because the SEC said, don't pretend like you've got historical financial statements. Your acquisition of this entity really changed it, and you kind of need to have fresh start accounting to present fairly the financial statements of the subsidiary. But we won't worry about that until we get to chapter 11. But it's in this chapter. Why the authors wanted to put that there, I don't know. Okay, so these are our problems that we have assigned. 3.8, P3-1 and P3-9. These are a fair amount of work. 3-1 and 3-9 are templates. We're going to look at those a little bit because there's actual journal entries that we'll then make on those. So let's go ahead and look at the template, if we might, for 3-1. These were authored by Pearson, so a lot of times I refer to them as Pearson templates. I've had to clean them up so that they really work, so I've actually worked the problems on these, fixed. These are the ones that you can download from Pearson's website that were mentioned in the syllabus. You feel free to do that if you want to work problems above and beyond the ones that we work in class. But I've gone through and added those in. So what we'll do here is we've got our consolidated balance sheet working paper for Penn and Sutt, and let's just look at the problem facts for P3-1 here. Okay, so we're preparing a consolidated balance sheet at acquisition and computing net income 1 year later. So Penn Corporation is buying 80% of the stock of Sutt Company at book value. The data reported on separate balance sheets immediately after the acquisition is as follows. This is what you see here. At December 31, Penn Corporation owes Sutt $20,000 on accounts payable. So we've got an intercompany account payable. So we're going to prepare a consolidated balance sheet for Sutt. It's bought 80% of Sutt for book value. What we've got here this is what I have added to the Pearson spreadsheets, and I call this our suite of 7 consolidation entries. This is our suite of 7 consolidation entries. So these are the entries that we're going to make over and over and over in the next 4 chapters, is these 7 entries. And as you can imagine, we're not going to deal with each of them in every chapter. So starting out, if we had any errors or omissions that were stipulated in this problem, we need to make those adjustments. Errors and omissions are things like a dividend gets paid by the subsidiary, but the parent didn't receive it. So we need to book like a dividend receivable to get our investment account right. We're not going to deal with that right now, but those are errors and omissions. There's none in this problem. There's also no intercompany profit in this problem. Intercompany profit is the topic of chapter 5, and we will get to that soon enough. Adjust the investment in the subsidiary back to the beginning of balance. Well, this is as of acquisition, so we don't have to adjust it back. That would be undoing the equity method entries that the controller of Penn made on Penn's books. And you'll see that in subsequent problems. We won't deal with that tonight. We'll record the non-controlling income and dividends. Well, again, this is at acquisition. The non-controlling interest hasn't gotten any dividends or earnings yet. We'll eliminate the investment and subsidiary equity. So let's just do that. So we've bought, here, Penn has purchased 80% of the stock of Sutt Company at book value. Easy. So what we're going to do is we're going to go ahead and we're going to draft a nice entry for Professor Howell to read here. So we're going to have common stock of SUT. And that's going to be 600. I think this is okay, but I guess we'll find out. We'll have the retained earnings. And that's going to be 400,000. No, how about 400,000, not 4 million. Then we're going to eliminate the investment in SUT, which is on Penn's books. That's 800. And then we're going to record our non-controlling interest. Well, what do we need to balance this transaction? We got 600 and 400, so we got $1 million there. 800, so we need 200. Okay, and we'll simply book that on our handy-dandy Pearson spreadsheet here. And that's entry 5. Oh, don't need it there. Need it over here. The credit, 800. We'll do the debits first, like a good accountant. 5, 600 there, 600 there, 200 there. Yeah, thank you. A little creative there. Okay, our trial balance is our balance sheet. This really is a balance sheet work paper. It's really not a trial balance. Our balance sheet working papers still in balance. Our journal entries match. We've eliminated the common stock and retained earnings of SUT. What comes through on the consolidated statements now is the common stock and retained earnings of Penn. We've recorded our non-controlling interest, and we've eliminated our investment in SUT very, very nicely. We didn't have any fair value differentials in this one, so we didn't have to amortize anything. If we had fair value differentials, we would have probably been recording them here as part of journal entry number 5. And then we've got other reciprocal accounts. So we do actually have one thing because it says Penn Corporation owes SUT $20,000 on accounts payable. So we're going to have accounts. We're going to get rid of that. Can't type for beans. And that's going to be nothing works. And we'll credit accounts receivable. So then that entry is going to come over here. Thank you. Much better.
Should be able to.
Oh yeah, thank you. Okay, so our entries are in balance. We only had 2 consolidating entries to do on this balance sheet work paper, but our entries are in balance. And that is our consolidated balance sheet. We've eliminated intercompany payable, receivable, reciprocal accounts where they've transacted with each other. We've eliminated the investment that came over from the parent's books, the investment in the subsidiary. We've eliminated the subsidiary's equity. We have established and recorded the non-controlling interest in our consolidated balance sheet.
So I guess my question on homework is like, is this all you expect us to turn in? Because what I did on a lot of the chapter 1 problems is I did a worksheet like this, and then I actually prepared the balance sheet in good form, and like, do we need to do that? Okay, you just want to
Just
see the
complete the
numbers in
worksheet, yeah.
accounts.
Yep.
Okay,
We'll have a lot of these worksheets in this class.
okay.
Yeah, we'll have a lot of these worksheets in this class. We'll have a lot of them in 4, 5, 6, and 7. So we got the 2 here and 3, and then we'll have lots of them. And the take-home problems will be in this format. So the other thing that we'll do over here, which we didn't need to do in this problem because they bought for book value, but I like people to show their and I'll illustrate how to do this. Is just do your preliminary computations over here, which would be like, you know, we paid 800 for the investment subsidiary. We got 80%. That's the implied fair value is $1 million, right? Those sorts of things. Fair value differentials. We'll have our little fair value differential amortization work papers over here. Kind of our little work paper embedded over here. And then down here have an analysis of the investment in the equity accounts, which we don't really need to get into tonight. But this is just meant to be an introduction. You know, 3-9 has a little more meat to it, but not much. I think this one we have a reset back to the beginning balance. So part of that's going to be undoing the equity method entries. Yeah, because we will have that. We've got an excess allocation that we're going to do, amortize some fair value differentials, and eliminate other reciprocal accounts. So this one has some more meat to it than that one. But again, it's just a balance sheet approach. We don't go into the income statement in any great detail at this point. Okay, so a fun week of homework. I know people have a lot to do. You know, let me know if you're having trouble getting through all of it by Saturday. I think, you know, some leniency here early in the term is appropriate in these circumstances, especially with Beta Alpha Psi and everything going on. Thank you for your attention tonight. I'm glad we got through the material. Don't hesitate to call me, and please, next weekend may be a little tough for me for office hours, but don't hesitate to give me a call and say, hey, I really want to talk to you before class, and I'll do my best to get down here.
Thank you.
Yeah, thank you. Thanks for your attention.